Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Wednesday, the 10th of July. I'm Daniel Lam, your host for the podcast. I've always spent most of my career as a debt strategist on the institutional sell side and on the wealth solution side of the businesses. I only spent a couple of years in a typical sell-side research setting. It was a curious experience for me, because in those days, it was predominated by single-stock fundamental analysts, and those who look at the macro side of things. In such a setting, they were actually considered as a minority, even though that was already after the global financial crisis, when the central banks became, quote-unquote, the only game in town, and the markets were dominated by macro and not micro factors. And that continues until the last 12 months, I would say, where equities, especially those in the US, started to move on idiosyncratic factors. For example, the AI theme. And the moves after key figures like the non-farm payroll and the CPI became less significant compared to, say, from 2020 to early 2023. Now, given the context, the second quarter US earnings season, which is starting this week, will gain extra importance. It's starting with reports from major US banks on the 12th of July. Now, according to the IBIS estimate, consensus expectations are for the S&P 500 index to deliver 10.6% year-on-year earnings growth in the second quarter. And that's led by the communication services sector at 21.7%, healthcare at 20.2%, and technology at 16.9% year-on-year earnings growth. Now, in contrast, materials and real estate sectors are likely the laggards. The expectations for FY24 has also been revised higher to 10.7% from below 10% at the start of April. So we believe positive earnings revision in US markets, i.e. the number of companies with upward revisions exceeding those with downward revisions, the strong return on equity, as well as the potential Fed rate cut in the second half of the year, will support a continued uptrend in US equities, especially in growth stocks, despite the macro uncertainties. Now, in particular, we favor sectors with high earnings growth expectations, and that includes technology and communication services, in order to capture the rising momentum in AI investments and cloud computing. We expect the AI theme to broaden out from the initial Magnificent Seven companies to other sub-industries in the tech sector, including semiconductor, software, and AI-powered personal computer companies. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.